Coming up today, stocks trade mixed, gold sells off hard, the newest meme stock, the latest from Netflix, Amazon's robot plan, and what happened today that hasn't happened in over 12 years. It's going to be a good one, guys. Let's go. And welcome back, everybody, on another interesting day in the markets. We've got quite the significant and sharp sell-off happening in precious metals today, with gold actually having its biggest losing day since April 2013. And I'll get a bit more into that soon, but just looking across the rest of the market, we've actually seen a little bit of a rotation into cryptos, a bit of weakness in small caps and meme stocks, and a bit more of a rotation into old economy stocks. Whilst international markets were largely in the red today. S&P 500 finishing right on flat, the Russell 2000 coming off a bit, but all indices trading in a really narrow range. And we've got quite a few hot stocks and sectors coming off hard today. Rare earths, after we just saw Trump sign a critical minerals deal with Australia, increasing the prospect of supply, along with the pursuit of lower prices. That caused a pullback, but I still think the long run tailwinds for rare earths are very much present. And like I said last week, after we got those reversal signals showing a bit of an exhaustion after a really good run up, it's no real surprise. And I was actually expected to see a bunch of these hot names and sectors pull back to their moving averages like they have done now. Not just in rare earths, but in a lot of hot stocks out there like Oklo, other nuclear related stocks, NewScale falling quite sharply there today. And New Age Energy has been the hot trade. And again, a lot of these stocks just pulling back to their 50-day volume weighted average here in the yellow line, with some stocks that could still have a little further to go. AST Space Mobile got really technically overbought there last week. And the AI infrastructure trade, one of the hottest trades out there, could still have a few more days of pulling back and consolidation here. Then technically speaking, we'll be really looking some supportive price action. I still think the fundamentals are there, but no doubt a bit of froth and excess coming out this week. And even the hottest meme stocks of late, like Open, now been consolidating for a bit over a month. And what I've actually noticed this week is a little bit of a rotation into healthcare stocks, looking at small cap growth stocks like Oscar Health. And even though it pulled back a little bit today, one of the hottest stocks this past week and past month. Also in my long-term portfolio, Grail, another small cap growth stock in the healthcare sector, having more than tripled over the past 2 months. And looking at the largest retail broker, Robinhood, also having a bit of a multi-week pullback as we get into the thick of Q3 earnings season. Robinhood 2 weeks out, many of these stocks a week or two out from reporting. So you can see some profit taking going into that. Traders and investors that don't want to hold over earnings, the uncertainty around earnings, and that's why there's a risk premium. On average, stocks will gap up and perform well after earnings. And even more so if they're pulling back going into it, as long as the fundamentals are holding up. And that's why there's a premium after earnings results. And no doubt one of the most bubbly areas of the market, quantum computing stocks. Also having a decent pullback this past week. Just looking at Rigetti here, not even back at its 50-day VWAP quite yet, but check out the price action in the Rigetti 2X leveraged ETF. And so this is only leveraged double. There's a bunch of ETF fund managers out there currently applying for 3X and even 5X some of these stocks. And so we're just having a little 1-2 week pullback here, but look how much the 2X Rigetti fund has already dropped, 57%. Can you imagine the 3X? And what I think is crazy and shouldn't even be allowed, 5X. They're pretty much guaranteed to blow up at some point. And even this 2X fund has a good chance at having a drawdown so big, 95% or so, that it can't possibly recover from, even if the underlying Rigetti recovers. What's been holding up pretty well? The Entrepreneur Shares Private Public Crossover ETF. One I've been mentioning on this channel for a while now, as I've also got this in my long-term portfolio. And for those of you that watch the Palmer Luckey podcast on Joe Rogan, his company Anduril is actually present in this ETF portfolio with a small position. They also own SpaceX and Klarna, in addition to about 30 other publicly listed companies based on their entrepreneurial factor. So this fund gives you exposure to some of the hottest private companies out there like Anduril, a leading defense technology company that the US government will no doubt probably spend hundreds of billions of dollars on over the next 10 years or so. And so I think defense will be a great sector to invest in for many more years to come. But just getting back to the main headline from today, gold and precious metals tanking. And I mean, who could have saw this coming? All these millions of consumers lining up around the world to buy gold. Did they time the bottom or did they time the top? No doubt there's been good fundamental tailwinds for gold these past few years. The biggest of which, de-dollarization. Global central banks looking to replace their US treasuries with gold. We've seen that really kicked off since 2020. Central banks reducing the amount of US treasuries whilst also increasing the amount of gold. But that trend may not go on forever, and it very well could pull back and consolidate at some point. Because the fact fact is, the world still trades in US dollars. It's still the global reserve currency. US stocks still make up 65% of the world's stock market in terms of market capitalization. And just looking at the share of international payments via SWIFT, which is not a payment platform, but actually a messaging platform, the dominant one in the world. The vast majority of international transactions go through SWIFT, even in China. We can see the use of US dollar has actually been increasing over the last couple of years, while the euro has significantly shrunk. In other words, there's still plenty of demand for US dollar. It's not fallen off a cliff, as many of the fearmongers will tell you. And just think about it yourself. Do you want to get rid of all your US dollars and hold Chinese yuan? Would you rather hold euros? What about the British pound? I'm in no rush to replace my wealth in those currencies. I don't think the rest of the world is either. And like I said last week, we were just reaching peak measures of sentiment and positioning, looking at the amount of fund flow into gold and silver. And you can quite often see these big one-day dumps after a top has been put in. In fact, we just saw the biggest one-day fall in gold since late 2020, after which gold consolidated for the next 3 years. And so like I've been saying lately, I wouldn't be surprised if gold does the same thing for the next 3 years, or is even lower a year or so from now, which I know is a huge contrarian call because there's just so much bullishness out there, because people think central bank buying is going to go on for infinity and the US dollar is on its way to zero, when the data and reality suggests otherwise. And if foreign central banks end up owning too much gold, what position does that put the US government in that is now crypto friendly? Could they maybe start selling some gold and buying Bitcoin, as they're already talking about it as a strategic reserve? Because China is actually anti-crypto, so that would actually be a smart move from the US government. If China and Russia did end up trying to corner the world's gold market, it could very much become a geopolitical football. Or are all those millions of consumers that piled into gold last week, are they right? But it wasn't a complete sell-off across the board of all high beta risky assets today. In fact, we saw a huge rip in the long-forgotten plant-based food company Beyond Meat, after it was just recently added to the new meme stock ETF, and they also just announced an expanded distribution agreement with Walmart. And that's all these beaten down stocks with high short interest need. Just a new catalyst, something to show that it's going to hang around just for a bit longer, because the stock was up 127% yesterday, up another 146% today, still ripping after hours as I speak, going down to a 5-minute chart there. Huge amounts of volume. Retail traders having a good time with this one, showing there is still appetite for these turnaround stocks. But a big part of it is a high short interest. Hedge funds that have shorted the stock are forced to cover when it gets squeezed higher. They have risk mandates. A lot of them can't let a short position become greater than 5% of their portfolio, so they have to start covering shares, and that just adds further to the squeeze. Beyond Meat, as of yesterday, had 42% of its float shorted, and here's a list of other stocks that could go the same way. Hertz, Hims & Hers Health, C3 AI, Soundhound, and a few others on here that are already being well traded by the market. One of my favorites, Lemonade, and as usual, plenty of biotech stocks can be vulnerable to short squeezes as well. But it's getting back to the market. Even though we've seen a sharp spike in volatility last week, it happened while the S&P is still within 3% of an all-time high, which is actually a very bullish signal. 2 months to a year later, we're higher 100% of the time, with the market given more than double the average yearly return. But the last few times it happened, the market did peak out within 2 years later, in 2020 and 98. And the bulls are still out there in force. Tom Lee still thinks the S&P 500 will close at 7,000 or higher by year end, as he believes there's going to be a big chase from Wall Street, as about 80% of fund managers have underperformed the market this year, and the average Wall Street bank's target is still below the market. And like I showed last week on my S&P 500 oscillator, it was interesting because Friday it touched the oversold level, which is strange looking at the chart because the market didn't even look like it was that technically oversold, but it was giving signs that we were in a short-term bottom potentially. And so we still haven't quite taken out that big bearish candle from 2 Fridays ago. The high on that is 67.62. If we close above that, that may prove to make this candle just one big sharp shakeout, as the overall fundamentals for the market are still really good. Going into a bullish seasonal period, Q3 earnings already off to a great start. Most companies beating more than 85%, which is well above averages. The Fed meets next Wednesday, which they're highly likely to cut rates again, possibly also for their last meeting in December. Jay Powell's going to be out a few months later in May next year, pretty much guaranteed to get a really dovish Federal Reserve chairman who will probably cut rates even further, as I think they're just going to run it hot, not too concerned with 3% inflation. And so that's a massive tailwind for risk on assets. Still got the massive AI infrastructure spend, momentum building and robotics, all-time high record retail participation, and we haven't yet reached records in terms of margin debt. And on some measures, that sharp vertical run up in 2020, early 2021 was way more frothy than what we've seen this year. So still very much the potential for a melt up going well into next year. Then it could be late 26, 27 that the Fed may be forced to raise rates. We may see a slowdown in capex or something else that could cause us to have a bit of a top. And don't forget, you've got a really pro-business administration that's doing everything possible to juice the economy and market higher as well. That's a very hard thing to bet against. And the most pressing issue right now between the US and China working out a new trade deal looks still to go ahead. Of course, anything can happen day to day, but at this chance, the market's pricing in 75% probability Trump will meet with Xi Jinping by the end of the month, and that the US and China will have an agreement or an extension to an agreement by November 10th. So they very well may just kick the ball down the road, but the market should be okay with that as long as it does see a trade agreement on the horizon. But again, long term, the West is already decoupling from China, so as time goes on, it becomes less and less of an issue, as countries like Vietnam will play a much larger role in the global supply chain of goods that require low-cost labor, at least until industrial robots are well and truly up and running in the next 5-10 years. Companies like Vietnam could continue to benefit and have already been performing really well these last few months. Just moving on to Netflix, we just got their earnings coming in with a miss. Very much against market expectations, the company blaming a Brazilian tax dispute. The company no longer reports its subscriber numbers, but it said it hit the highest quarterly view share ever in the US and UK, which is still growing, along with their revenue coming through with pretty good double-digit numbers, especially in Asia Pacific, 21% year over year. Still very healthy margins, but at over 52 times earnings, no surprise to see the market having a bit of a pullback after hours, as they did come through with a pretty decent miss. 15% on earnings per share. So it looks like we're going to gap down to around 1160 tomorrow on Netflix. Doing a lot better this week, Apple, getting close to hitting 4 trillion market cap for the first time ever. Only Nvidia has achieved that status, but they are coming through with some good numbers on their new iPhone 17, really what the market had been looking for, and also performing well in China. Stock actually reached an all-time high today. You can see from the price action since last earnings, it's been really strong up and to the right. Doing even better today, Amazon, with some internal documents showing the company has far-reaching plans to automate 75% of its operations. And so Amazon's America's second largest deployer after Walmart. They have hundreds of thousands of warehouse workers, an army of contract drivers, but now some internal documents reveal they're on the cusp of a big shift. Already planning to avoid hiring more than 160,000 people it would otherwise need by 2027. And even though they expect to sell twice as many products by 2033, some estimates show they may not hire more than 600,000 people that they normally would to support that growth. And that's thanks to robotics, which you can bet your bottom dollar these big companies are going to invest and do all they can to replace as many people as possible, because robots, even though they're more expensive now, they won't always be. Like any new technology, the cost drops, they become more efficient, and robots can work around the clock. They don't call in sick, they don't cause disputes, they don't form unions. And so I think we are currently witnessing the slow death of human labor from many industries and the rise of robotics. Of course, it's going to play out over many years, but it's possible within 10 years, warehouse workers could be a thing of the past. And what that means for all these people that currently work in warehouses and factories is still yet to be seen. But to the stock market's ears, that's great news. Amazon up 2.5% today, the best performing stock out of all mega cap tech. Moving on to DraftKings, after recently getting slammed after the market caught on to the huge growth in prediction markets. People leaving traditional sports books, getting much better odds on Kalshi and Polymarket. We've seen DraftKings scramble, now acquiring a prediction platform themselves called Railbird, as management has likely realized the huge threat they've got to their business and may actually try and completely pivot to prediction markets themselves. But is it already too late? The market doesn't seem all that excited. It's up a bit here after hours, but still well below where it was trading a few months ago before we started seeing the huge growth in prediction markets. Moving on, we just heard from the Chicago Board Options Exchange, CBOE, pushing to extend equity options trading as global demand surges. Stocks are pretty much moving to trading around the clock, as there's now a few exchanges that facilitate trading after post-market close at 8 p.m. New York, and they reopen for pre-market at 4 a.m. As finance in general works around the clock thanks to crypto competing with traditional finance, making the whole system transparent and faster to process transactions. I think this is inevitable as well, and it's a good thing whenever accessibility is increased. So this should be approved by the SEC. Then sometime in the next year or so, we're likely to get a pre- and post-market session for options as well, as not everybody around the world is awake or can be in front of their desk in US business hours. And again, it just makes American exchanges more competitive, helping to retain their global dominance. One other area America wants to maintain its leadership is in space exploration. Just looking at this data here of the amount of launch attempts into space of China versus America, excluding SpaceX, China's been steadily on the rise and has actually done multiples more attempts than America, but not including SpaceX. If it weren't for Elon Musk and SpaceX, China would already be well out in front of America when it comes to space. But SpaceX launches more rockets than the rest of the world combined, and it's still only early days for them, even though Musk has been running the company for 23 years now, which I think benefits the entire space industry. We should see a pretty good rally going into the SpaceX IPO, which hopefully is some point in the next year or two. Like I said, investors can still gain exposure through the Entrepreneur Shares ETF. Alphabet Google also owns 8% of SpaceX, another way to get indirect exposure. But there's also ETFs like UFO, which, just looking underneath the hood, give exposure to a lot of satellite and space-related stocks. That could be a good long-term hold, but no doubt with plenty of short-term volatility for those that can handle it. And just wrapping it up, taking a look at key markets, seeing a big crush in volatility. That's a good sign. Back below its 200-day MA, with the term structure back into contango. Bond yield's still quite soft here. Credit spread's still quite tame. The dollar seemingly defending support. Bitcoin holding on a lot better after we got a massive dump in gold. That very well may have marked a bit of a peak, even if we just consolidate for a while, because the market may be somewhat cornered. Because if we do see a sell-off, all those millions of people that recently just bought gold, guess what they're going to do? They're going to cough it up and they're going to sell into the lows, further exacerbating the sell-off. So the market may be very leveraged long here, with a lot more potential to sell off hard. People don't realize that even big assets like gold can have significant volatility in the short term. Like back in 2013 when it was having 5, 7, 8% down days, September 2011 when it lost a quarter of its value in a couple of weeks, and even in the height of the GFC back in October 08, gold lost a third of its value in a couple of weeks. And of course, after it peaked out in early 1980, it had about a 50% drawdown in 2 months, which I don't think a lot of people realize it can move like that because it hasn't done it for a while. They haven't seen it, so they don't expect it. So no doubt there'll be some interesting price action in gold going forward. I still think silver and uranium are better places to currently be. And until there's millions of people lining up to buy uranium, I still remain bullish on it, even though for sure it too can have a decent 20 or 30% pullback. Otherwise, I think overall the market will still be looking forward to another rate cut next week, which if we get will be very supportive of the markets. And that's a wrap for today. Thanks very much for watching, and I'll see you back here again this time tomorrow. Cheers.